So I think I've decided the best way to describe student loans. They're like a never-ending hangover. In college, just a little hair of the dog and you forget all about it. And then you graduate and you're like, oh, I'm gonna get a job, make a bunch of money, get an apartment, drink fancy wine. And then all of a sudden, you remember you have student loans. And the real world gets very real, very fast. And I know I'm not the only person this has happened to. 43 million Americans have student loan debt. And for people between the ages of 20 and 30, the average monthly payment is more than $350. That's a big chunk of your budget. I'm not trying to scare you. When you take out student loans, you're investing in your education so you can get a better job and make more money down the road. What I want to talk about is actually understanding your loans. And we're talking real world here. You don't have to know everything. You just need a little common sense. So when we're talking about student loans, there are two main types, federal and private. So let's take a closer look at federal student loans. You apply by filling out a form called the FAFSA, which determines your eligibility for grants, loans, and work-study projects to help you pay for college. The money helps you cover things like tuition, housing, and school supplies. With grants, you don't have to pay the money back. With loans, you do. The most common type of federal loan is a direct loan, also known as a Stafford Loan. Stafford loans have a fixed interest rate and the amount depends on your needs. But then there are two types of Stafford loans, subsidized and unsubsidized. Subsidized loans don't start accruing interest and don't require you to make any payments until 6 months after you graduate. So these loans are a great deal. They're your best option. But they're reserved for people who have a greater financial need. But not everyone can get subsidized Stafford loans. Then there's unsubsidized Stafford loans. They're available to more people, and these also don't require you to pay them back until 6 months after you graduate. But here's the big difference. With unsubsidized loans, interest accrues while you're in school. So if you don't pay off those interest charges while you're in school, you'll end up paying interest on your interest because it's all added to the total balance the entire time you're in school. There's also direct plus loans. These are for graduate or professional students, and parents of undergraduate students can also get these loans to help pay for costs that aren't covered by financial aid. Another type of federal loan is a Perkins loan. Now, these loans are available to students with more extreme financial need. With a Perkins loan, you borrow the money through your school's program, so the school is the lender. If you qualify, the amount you get depends on your needs, how big your needs are, and how much money the school's program has to give out. Also, not all schools have this program, so you may not even have the option of a Perkins loan with your school. So let's skip to the important parts. Your best option for a student loan is a subsidized Stafford loan, and here's why. With a subsidized Stafford loan, the interest is paid by taxpayers while you're in school, so you don't have to worry about that. When you graduate, your loan balance is the same amount you borrowed. You also don't have to start paying it back until 6 months after you graduate. You can also delay your payments, which is called deferment. During that time, no interest is added to the loan. How much you can borrow depends on your year in school, so it's different for freshman year, sophomore year, etc. So that's your best option, a subsidized Stafford loan. Once you've reached the limit on the amount of subsidized Stafford loans you can borrow, your next best option is the unsubsidized Stafford loans. But even though it's your second best option, you want to borrow as little as possible in unsubsidized loans. Because here's the biggest difference. With unsubsidized loans, the interest accumulates while you're in school. So when you graduate, you already owe more than you borrowed. And if you don't pay those interest charges while you're in college, you could get a big surprise when you look at your loan balance after you graduate and realize it's a lot higher than the amount you borrowed. As a third option, parents can help their kids by taking out plus loans. These loans do have a higher interest rate, about double the rate for Stafford loans. And a parent can borrow up to the cost of attendance to help cover the cost for their child. Now let's talk about private student loans. When it comes to student loans, private ones are the worst. Here's why. They typically have really high interest rates, so they're going to cost you more over time. Also, there's really no wiggle room when it comes time to pay them back. You don't have options based on your income or all the different options like you have with federal loans. When you're borrowing money for college, there are 3 main rules to remember. All right, rule number 1, Never borrow more money for the cost of a 4-year degree than you expect to make in your first year's annual salary. All right, rule number 2, consider going to a 2-year school and then transferring your credits to a 4-year school for the last 2 years. This can cut your cost of college way down. And nobody really asks you where you started college, right? Just where you graduated from. Rule number 3, don't take out private student loans. We talked about this, but it's worth mentioning and emphasizing over and over again. Finally, let's talk about how to pay off your student loans. That's something everybody with student loan debt wants to know. If you have federal student loans, there are a few different options you can take advantage of to help you pay them back. But again, these are only available for federal student loans. The first one is income-based repayment. So there are a few different types of these plans, but basically the way it works is it helps borrowers keep their loan payments affordable because it caps your payment based on your income and family size. The more money you make, and as your family size changes, your monthly payment will be adjusted every year. The second one is pay as you earn. This program caps your monthly payments at 10% of your income, so it helps you keep your payments affordable. And then all of your debt is forgiven after 20 years of on-time payments. If you took loans out before 2007, your payments are capped at 15%, and you have to have on-time payments for 25 years to have your loans forgiven. But after all those on-time payments, the balance of your loan is wiped out, gone. See ya. The third one is loan forgiveness. So even if you already take advantage of the repayment options, there are also ways you may be able to have your student loans forgiven. Public service employees and other types of workers can qualify for full loan forgiveness after 10 years of monthly payments that are on time. So you definitely want to make sure you check if your job, your field, your industry, if you qualify for this type of loan forgiveness. It can be a huge saver. And then there are other options like deferment and forbearance. These programs allow you to postpone your payments, typically for a year or so. The advantage of deferments is that interest does not accrue on subsidized federal loans during the deferment period. But again, that's just subsidized loans. On the other hand, forbearance may be a little more flexible in terms of the postponement or delayment period. But interest does accrue during the time you delay your payments. So just make sure you have an idea of what interest is accruing and how much you're going to owe after you've put off paying your payments. But what do you do if you're past the point of being able to delay your student loans, or an income-based repayment plan doesn't make sense for you because you're making too much money? That's where refinancing comes in. And this has helped a lot of borrowers reduce the cost of their loans and get them paid off much faster. And refinancing can be used for both federal and private student loans. If you aren't sure whether you should refinance your student loans, here's when it's your best bet. First, you want a lower interest rate. If you took out federal loans when interest rates were high, like around 6.8%, or maybe you took out a private loan to pay for costs that federal loans didn't cover, then you should consider refinancing. You may be able to get a lower interest rate so you can reduce the total cost of your loan over time. Second reason, if you have great credit or a cosigner. Lenders offering student loan refinancing use a lot of factors when they determine whether they'll give you a loan to refinance your other ones, including your credit score, income, education background, and your employment history. And the importance of each factor is different for each lender, but as a general rule, you'll get better offers, lower interest rates, if your credit score is in the 700s or 800s. So if you have a good credit score and you're facing big student loans, consider refinancing them. You also may want to consider refinancing if you have a solid income. Maybe you don't have stellar credit, but having a solid income relative to your debt can help you get a good refinance offer. But it's not just your student loans that the lenders will look at. They also look at credit card debt or other loans you have, maybe a car loan. But you should look into it because it can help you get a lower interest rate and reduce the cost of your loans over time. And if you don't qualify for a good offer now, it doesn't mean you can't get one later. So who should not refinance their student loans? When you refinance a federal student loan, what happens is the lender pays it off for you and issues you a new private loan. So that means once you refinance, you can no longer take advantage of those federal student loan repayment programs, such as the income-based, deferment, forbearance, forgiveness, all of that. So make sure you've gotten everything you can out of those federal programs before you decide to refinance. So refinancing your student loan to a lower rate will of course save you money over time. But if you choose a shorter loan term that can save you a lot more money as well. So the downside is your minimum monthly payments may go up, but the upside is you'll get the loan paid off faster and it'll cost you less over time. So if you can afford it, choose the shorter loan term. And we have more details on all of this and resources for all of your options at clark.com/commonsense.